Good morning and welcome. It's Wynne Harvey, Investment Advisor with Richardson GMP. Today we're going to talk with Craig Basinger and Chris Curlow about current economic conditions and the outlook for the market. This call is timely given the increased volatility we are experiencing and with concerns raised over or about China, Europe, and the U.S. I've given Craig and Chris a list of questions that I think are of interest, and they're going to address it within their presentation. For those of you who don't know Craig and Chris, Craig is the Chief Investment Officer and Lead Portfolio Manager for Connected Wealth, the asset management division of Richardson GMP. Connected Wealth manages over $350 million, primarily focused on Canadian and U.S. equities. And for a lot of you, you are invested directly in his portfolios. So I'm now going to turn it over to Craig and Chris, so please go ahead.
Thanks, Wynne, and good morning, everyone. Thanks for joining us today. I think we'll start by just saying that our next quarterly market outlook is going to be out probably in the next week or week and a half. And a lot of the content that we'll be talking about today is from that report or going into that report. And again, everything that we do as far as what our views of the markets are and what our views on individual companies is all available on connectedwealth.com for those who want to read a little bit more. So just we'll take a quick step back and provide a little bit of a recap. Like, there's no question there's been a lot of volatility in the markets over the last little while. That's obviously not too surprising. And the markets have certainly been taking it on the chin. The Canadian market, the TSX, has been declining for a fair bit longer, while the U.S. market has sort of accelerated its decline just of late. But, you know, so far, 2015, we have one quarter to go, is obviously stacking up. It's a pretty tough year. The TSX is down 7%, S&P is down 5%. The CRB, which is a broad basket of commodities, is down 16%, which obviously doesn't help our markets up here in Canada, being a little bit tilted towards the resources. And that's obviously been what's been impacting the Canadian dollar as well, which is down 13% against the U.S. dollar. Broadly speaking, though, this isn't just a Canadian or U.S. thing. World markets are down 7.6% so far this year. The biggest things that have been weighing on the markets, in our view, is one, just concern about China as they sort of go through their little bit of popping of their equity bubble, and also what it actually means to the Chinese economy. This has been resonating into emerging markets, and really underneath all of this is the fact that we are entering a very divergent phase as far as interest rates go, where the U.S. may be on the verge of raising rates while everybody else is moving in the opposite direction. Well, that may sound all terrible and bad. This is, you know, it's been 4 or 5 years since we've had a material pullback back to 2011. We've been buoyed. Markets have been inflated somewhat by a lot of quantitative easing, very low interest rates, and that's elevated valuations considerably. So this, in our mind, is a partial unwinding of that. Underneath that, underneath the sort of drawdown in valuations, as we've seen the TSX go from 19 to 16 times as far as a price-to-earnings ratio, we've seen the S&P go from 18 to 16. You know, underneath that, there are some pretty strong positives. The broad basket of economic data out there continues to be quite encouraging, and gasoline and oil prices, while it hurts a lot of our market, has a strong global dividend, which we believe is just starting to show up in some of the data. But we don't want to talk about the past, we want to talk about the future. And, you know, in our minds, we are still in the late bull phase of this market cycle. That being said, we're seeing some loss of momentum on the economic side, especially in emerging markets. This chart that we're looking at here is showing the bars on the right-hand side are essentially expectations for economic growth among emerging markets over the last year and how they've been declining. But I think encouragingly on the left-hand side is the developed markets. And, you know, we've been seeing better numbers out of the U.S. and more encouraging numbers out of the U.S. We're seeing some improvements in Europe as well. So the developed market actually matters a lot more as far as the global economy goes. And the fact that they're holding in relatively steady, I think, is a pretty positive sign that this isn't quite the end of the bull market phase at this point. And this one also, this chart also speaks to that. This is the S&P is the beige line, and the blue line is leading indicators. And leading indicators are a basket of 14 different economic and market indicators that the U.S. economists use to provide some insight as far as what the economy is doing. And the fact is if this is still rising, which it is, the blue line is. It has us much less concerned about this recent pullback as far as being an end-of-cycle type phenomenon. You can tell that the leading indicator has rolled over and started declining well before the markets started to sell off during the last two bear markets. So again, because this is still relatively strong, I think that's a positive sign. We have housing contributing more, labor, unemployment's back down to 5% in the U.S. The U.S. consumer is under-leveraged, so it still has us relatively confident that this market cycle has further to go and that we're just in a correction territory. So we think we're here, and this is a lot of our asset allocation work. We break things down into this market cycle, and it breaks things into the bear market and bull markets, but it then further slices those into different phases. And we believe we're about halfway through the late bullish phase. Obviously, the next thing that comes is orange, which is bad, because it's called a bear. But the fact is this late bull phase tends to be a longer one, tends to be more volatile, which I'm sure everybody's clearly noted at this point. But again, it also tends to have some pretty strong equity returns. That being said, as we do approach getting closer to the end, we do continue within our portfolios and within our approaches to gradually start migrating towards more quality. So we call this the year of divergence in our outlook back in January, and that I think has continued. This is the economic growth from a year ago versus today across a basket of different key economies. And the fact is there's a lot of good ones out there. India's improving, Italy's improving, Japan is getting better, still negative, but actually the negative is getting smaller. The UK is still growing at a decent pace. Germany's improving, US is improving. Although there are some bad ones as well, China, Russia, Brazil, and I circle China there as well, even though it looks like it's rising, because I think that number's coming down. I think everybody's, that's where the consensus is now anyway. Canada's doing worse, France is doing worse. So the fact is we have this very divergent amount of economic growth. We have some doing well and some doing poorly. And we're seeing that on the monetary side too. You have quantitative easing, which is the open market buying of bonds to help suppress interest rates and jam more liquidity and credit into the system. This is still ongoing in Europe and in Japan. However, the U.S. obviously stopped its quantitative easing about a year ago. Then we have interest rates rising in some areas. So this is obviously a hawkish move, but Brazil is raising its interest rates, trying to defend its currency. Indonesia is raising theirs. The U.S. could be on the verge of raising theirs, which we believe will likely happen this year. However, everywhere else, interest rates are falling or being cut. We have India, China, Chile, Japan, Australia, Europe, across Europe, Canada. The list goes on as far as countries that are becoming more accommodative on the monetary policy side. Again, what I'm highlighting here is that it's divergence. We have some moving in one direction, others moving in the other, and that creates a more volatile world, which is the environment that we're living in now. This chart here just shows volatility going back across a number of key asset classes, equities, treasuries, and again on the U.S. side, and then also foreign exchange. Each of them has the thick blue line is for equities. The thinner blue line is the very long-term average volatility for equities. So, treasuries are still less volatility than usual. Equities are a little bit higher, but not an insane amount higher volatility. And then currencies are actually just back to where the norm is. I think we've gone through a 4-year period of suppressed volatility, and I think we're just returning to more normal market environment for volatility, which obviously will make things bumpier. And I think that sort of comes with this late bullish phase. You see the market wrestling a little bit more with, is it going to move higher? Is it going to move lower? And wrestling with what the next direction is. That creates opportunities, but it also creates bigger moves up, bigger moves down. And we're seeing this in other metrics as well. This chart on the bottom is the all or none measurement, which tracks essentially how many days a year you have almost the entire market moving up or the entire market moving down. And those are on the rise again, most notably yesterday. So some of our key themes as we continue to move into Q4, and this is obviously isn't a quarterly outlook, this is longer term. We're creeping back, and we have been creeping back into the quality side. So, one of the areas, this may surprise many listeners, but the dividend strategy has actually been an inferior strategy for much of the last 18 months. Hard to say negative things with dividends, get in trouble for that in most places. But this is showing you the U.S. market, and this is the U.S. market versus the U.S. dividend-paying market, and it's the two lines follow each other quite closely, but the orange line is going to key on here. This is the relative performance of the dividend strategy versus the broader market. And because for much of the last 3 years in the U.S., or 2 years, it has been gradually declining, that means that the broader market is outperforming the dividend strategy within the U.S. market, and a lot of that has been momentum. We think that started to change, and we think it's going to accelerate. Some of the reasons are the earnings multiple is now about the same on both sides. Obviously, the dividend strategies are less volatile, historically higher quality, and the yield on the dividend side has moved over 4%, which is pretty attractive in the U.S. that tends to yield much less than our market. Canadian market as well, the dividend strategy has been losing out to the broader market probably for much last couple of year plus. But we believe it's starting to turn here in Canada as well. It's a little bit more difficult in the Canadian marketplace because our dividend marketplace does have some lower quality names, so I think you need to be a little bit more selective. But the valuations are attractive in the Canadian marketplace on the dividend side relative to the broader market, along with the dividend yield. So one of the final couple things we'll talk about is Canadian dollar and oil. This is obviously a chart of the Canadian dollar. Gradually moves from the upper left to the bottom right, and has been relatively unrelenting in those moves. We still love the U.S. dollar. We've loved the U.S. dollar for quite a number of years. We love direct exposure. Most of our flex mandates that own both Canadian and U.S. are close to, they're not quite at, but they're relatively close to the top end of the maximum amount U.S. exposure that they're allowed to have based on their mandates. Our investor profiles that combine active management and ETFs are all overweight U.S. and overweight international, in fact. And on the Canadian market side, we also focus a lot on Canadian companies that have significant operations in the U.S. So we are big fans of the U.S. dollar over the Canadian dollar. However, I will say that we probably love it less now than we used to. And I think the rate and economic differentials are widely known. Their rates are going up. Ours are either staying flat or moving down potentially. Their economy is doing better. Our economy is doing worse. This is all well known. Oil's gone down. Everybody's well aware of that. That's been impacted on Canadian dollar as well. And this chart on the bottom right here is the actual purchasing power parity of the Canadian dollar. And this goes back about 30 years. So these are very long cycles. In my mind, it was a very easy call in 2010, 2011 to say the Canadian dollar is overvalued, and that's when we started being extremely overweight on the U.S. side. A lot of that has been taken out. In other words, I still think we could get down to that minus 20% fundamental purchase power parity valuation on the Canadian dollar. But let me tell you, I think that last 10 is going to be a lot harder. So we still like the U.S. dollar, but we're going to gradually, likely in the quarters ahead, be tailoring that back a little bit, just because I think most of the easy profits have been made. But we're not doing it just yet. So on oil, U.S. production, this is amazing. We call the U.S. the worst swing producer that the world has ever seen when it comes to oil. When I say swing producer, it used to be Saudi Arabia. When oil prices would fall, they would cut production, oil prices would go back up. The problem was other people were stealing the market share, so they stopped doing that, and they just keep pumping oil. It sort of led to the U.S. being the swing producer. The problem is we have capitalism here instead of a king, and it makes it a lot longer for oil companies to come around to actually reduce production because they do not turn the tap off as they have done in the past in Saudi Arabia. So this chart shows you U.S. oil production. It has peaked, it has rolled over, but the fact is oil prices started declining 1 million barrels before the peak, and they kept increasing production all that time. And that's because if you're an energy company and you have money, you drill. And until the market stops giving them money, which has happened now, that's when things start to roll over because they're spending less money. So we think the market moves from overreaction in different directions. We call it the W's because we expect oil to sort of remain range-bound, but sort of bounce between anywhere from $40 to $60. It could go lower, it could go higher, but we think it's going to continue to sort of oscillate in that range. I think the market had underestimated the lag time it would take for the U.S. production to start to decline. I think now the market is underestimating how much the past CapEx cuts and reduced drilling and decline rates of existing wells, I think the market is underestimating how fast that will cause U.S. production to roll over and decline. So we've been buyers of late. We're still underweight, and we still focus on energy outside Alberta where we can. But again, we've been adding a little bit in the past few months. You know, one of the positive aspects is we're now at a point where there are more the speculative futures market is extremely bearish towards oil, which tends to be a positive sign for price going forward. So a few key themes, and then we'll just sort of open it up and have a bit broader of a discussion. You know, this is a bit of a reset. We had QE, we had things elevating asset prices for quite a few numbers of years. In my mind, I think this is a bit of a reset from that period. Some of the inflated asset prices are being deflated somewhat. The key point, though, is that it's not being predicated on broader, weaker economies, and that has us pretty well resolved that this is a market correction, not the end of this current bull cycle. That being said, we are getting closer to the end, but we do think it has some time to go, and this late bull phase, while more volatile, does tend to have some pretty strong equity returns historically if you look at past cycles. So we still think the cycle has legs. We are overweight developed international markets. That's the U.S., Japan, Europe. Biggest bet would be on the U.S. side. We are underweight the TSX. We went underweight back in July, primarily because a lot of the commodity and global economic and emerging market data was getting a little bit softer, and we have absolutely no weight in emerging markets. Probably one of our bigger calls going forward in the next couple of quarters is we'll be adding more on the quality side. We've been doing it within some of our portfolios, focusing on lower beta names and becoming more defensive. That's obviously helped us over the last little while, but we think that's the strategy to continue to gradually migrate to basically higher quality and a little bit more defensive. And again, because of where we are in the cycle, we have no ability to call market tops or bottoms, sadly. Hope you didn't think we did. But I'm a strong believer that you can manage the turns gradually and add value along the way. The next slide is our disclaimer. These are all just our opinions, and since we do not know your objectives, it's best to talk to your financial advisor, in this case, WIN, before making any investment decisions.
So I think at this point, Craig, because we haven't opened up the lines to questions, and I think you've answered within the presentation all the questions we really had. You know, is this a 2008? Are we going into recession? What's the outlook on the U.S., China? How are these things impacting? And it sounds like from an investing standpoint, you're just increasing quality over time and going more dividend focused, but it's to stay the course. So I really wanted to thank you and Chris for your time today and for putting this together, and we will send this off to clients. Thank you.
Great. Thanks. Have a good day, everyone.